In this video, I want to talk about how to generate reliable income for retirement through investing. How do you generate money, regular income during your retirement years as an investor? In the income replacement investing is a strategy aimed at generating sufficient income to replace or supplement other sources of income such as wages, pensions, or social security. This approach is often, used by retirees or individuals planning to, you know, to obtain a kind of financial independence. So here are, just an overview, of the key benefits, the pitfalls, as well as some the characteristics of, this kind of investing. So the key features is number one, income generation. Income generation. So it focuses on investment that provides regular income streams such as dividends, interest or rental income. Dividend from your stocks or shares, interest from your certificate of deposits or other special, savings accounts, or rental from rental properties. Number two is diversified income sources. Diversified income sources. This may include a mix of assets like dividend-paying stocks, bonds, real estate, and annuities to ensure a reliable income flow. Annuity is a kind of insurance product that guarantees you regular income when you sign the contracts involved. Number three is risk management. Risk management often involve strategies to manage risk and ensure consistent income, such as ledgering, and bonds, or diversifying, income sources. You diversify your income into different asset classes so as to be able to have regular income with lesser level of risk, particularly for those who are risk averse. Number four is withdrawal strategy. It uses specific strategies for withdrawing income from investments to maintain financial stability over time. It's not just about investing, in an instrument. Ask yourself, how is the withdrawal process? Is it tedious? Is it difficult? Is it easy? Is it cumbersome? You need to answer that question. It's a very important aspect of investing for retirement. Number five is focus on stability. Prioritize investment that offers predictable and stable returns. At least the return should be predictable and it should be stable, not something that is haphazard. It's not consistent. No, it should be stable, it should be regular. It's something you can bank on, that will supplement your income or supplement your wages, as the case may be. We want to look at the advantages of these income replacement, investing. Number one is financial independence. That's financial independence. It is aimed towards financial independence. So it provides a means to achieve financial independence or supplement existing income, which can improve overall financial security. It supplements your income and it helps to kind of reinforce, financial securities that will help you to at least retire and live comfortably. Number two is predictable income. There's that predictability when it comes to your returns. And it offers a more predictable income stream compared to relying solely on market appreciation or one-time investments. It's always predictable. You could get your income as at when due. It's something you can very easily rely on. Number four is number three rather is reduce reliance on employment. Reduce reliance on employment. And it can reduce the need to rely on employment or other sources of income, particularly in retirement. Is that reduction in reliance on you know other sources of income. Number four is inflation protection. With proper planning, income replacement strategies can include inflation, protected securities or assets that grow over time. You can invest in assets that are not highly affected by rate of inflation. Number five is flexibility. It allows for flexibility, in how and when income is accessed, depending on the investment vehicle one use. There's flexibility on how and when you are able to access your income. Number six is diversification. By incorporating various income generating assets, investors can reduce dependency on any single source of income. You don't get to over depend on a single source. In this case, you have many sources that could bring in income for you. We look at the disadvantages, and this has to do with number one, market risk. Market risk. So income from investments can fluctuate with market conditions, particularly for assets like stocks or real estate. There's that volatility, involved. Number two is inflation risk. Fixed income investments may not keep up with inflation, eroding purchasing power over time. Your purchasing power could be eroded, could be compromised because of the prevalence of inflation in the economy. Number three is longevity risk. It's a risk that income may not last for the investor's entire lifetime, particularly if investment underperforms or if withdrawals are too high. Somebody can outlive his income at retirement. You could outlive your income. It's a consideration somebody should equally look into. And then you have number four, interest rate risk. Fixed income investments, like bonds, can be negatively affected by rising interest rates, leading to lower income or losses. There's that inverse relationship between interest rate and bond coupon. The lower the interest rate, the higher you could gain from bonds, and the higher the interest rate, it will equally affect the returns on bonds. Number five is complexity, meaning managing a portfolio for income replacement can be complex and may require a deeper understanding of investment strategies and risk management. It's a bit complicated actually, and it's not as straightforward as simply going to the market to buy stocks. Number six is a tax implication. So income from various sources can have different tax implications affecting the net income received. Income from dividends may have a different kind of tax implication. Usually it is taxed based on your income, based on your income brackets. All these things will eat into your overall rate of returns. Number seven is economic changes. Changes in the economic conditions, such as economic downturns or shifts in interest rates, can impact the reliability of income sources. It will certainly, impact your reliance on this income. The economy tends to determine virtually everything. It determines the stock market's performance and other related investment categories. So income replacement investing, is a strategic approach. It's a strategic approach, designed to ensure a steady and reliable income stream, especially important for those transiting, to retirement or seeking financial independence. Balancing the benefits with the potential pitfalls is key to creating a sustainable and effective income replacement strategy. So you look into it and start from now. You don't need to wait until you retire. You can adopt this particular strategy from now, and you get to enjoy, during your years in retirement.